Good morning once again. This is grade 8 tutor. I'm in the person of Ajimai Derek. We are going to treat a wonderful course called the business finance. With business finance, we all know how businesses go about their operations. We are trying to understand how business finance or catch up with resources to keep the business going. We are trying to understand their concepts. So with this course, we are going to have a course outline. We are going to treat all these courses, talking of the overview of business finance and also key concepts, and also there are other concepts that we are going to study under business finance. And also we are moving on to the financing a business. Financing a business means how businesses get up to keep the operations going. We can have it from sources like external finance, internal finance. You can have it from internal sources, external sources, and other short-term sources and other sources as well. So with this, we are going to understand the financial planning and projected financial statements. We are going to understand the financial statement analysis and interpretation. So this is going to, we are going to treat all these under business finance. So business finance is such a wonderful topic to get up to, and of which we all need it, or it cut across every sector of profession, whether being in marketing, whether being in accounting, whether being in logistics, whether being in every profession that you find yourself into. It is expected of you to have a fair knowledge of business finance. So with this, we move on to understanding the overview, getting the understanding, or chapter one. We are going to treat the understanding on the overview of business finance. We are trying to understand what business finance always talks about, the concept, the key concept that we are going to treat under business finance. So with this, we are going to move on to the introduction. And before I move on to the introduction, let us first understand something that, so with this chapter, it introduces the foundational concepts and principles of business finance. So we are trying to understand, or this overview of business finance is trying to build us with a key concept, to build us with the foundational or with the basics of understanding, or it introduces the concept of business finance, which is the study of what? Managing a company's resources in achieving its goals. Hope you are getting it. So with these two key concepts in corporate finance or business finance that are pivotal in helping managers to value alternative choices are the relationship between risk and return and the time value of money. So before we the two key concepts is one, risk and return, the relationship between risk and return, and also the time value of money. So with this, before we get to know the relationship between something, first of all, let's have a fair understanding, let's have a fair knowledge of what risk is, of what return is. So if you have to explain return, and returns happens to be, it refers to the financial rewards gained as a result of making an investment. So the nature of the return depends on the form of the investment. So for example, when I talk of returns, whatever, or what, let's say you have invested in a certain kind of let's say for example treasury bill. The returns that you get from treasury bill, or the benefit that you get from treasury bill, are called what? The returns. The financial rewards you get out of an investment that you've taken is called what? The returns. Please, I hope you are getting it. Good. So return, they are the financial rewards. So any investment that you make, the rewards that you keep on getting every time, depending on the form of investment that you've made, the rewards that you are going to get every time, we call it what? Returns. I hope it's well understood. Good. So with this, we move on to understanding one of the key concepts, that is risk. Risk. So risk refers to the possibility that the actual return may be different from the expected return. So to make this simple and to make this understandable, I will explain it to be that, so with risk, as I said earlier, refers to the possibility that the actual return may be different from the expected return. So for example, let's take for this course, which is business finance. You've had a speculation that, oh, with this, for as for business finance, it's very simple. As for business finance, it's very easy. I can score 95, or you're expecting to score 95. You've not written the exams, you've not written anything. After you've written your exams and the results has been released, when you check into your portal, what you see is the actual results. But you were expecting that you would get 75. So let's see, for example, so let's make it like when you check your result, you had 75 or 80 in business finance. So with business finance, you can see that what you expected, which was 95, is different from what you are seeing. That's the actual what result. So for example, you've invested in the business and you are expecting, oh, with this business, I would get a profit, or I would get a profit of, or a return of 50%. But here is the case that although you've not started anything yet, but after the operations of the business, you get to know that your return is 20%. So with this, you can get to know that your actual return is different from the expected returns. Please hope you're getting it. So the actual return may be greater than the expected return. Or sometimes too, the expected return can be greater than the actual return. They are all risk. So risk is not a matter of something happening to you. Hope you are getting it. So risk is not a matter of something happening to you, or maybe getting up to some. No. They are all parts. They are trying to let you know that the risk is what? The deep having the differences, or the possibility that the actual return may be different from the expected returns. We hope you are getting it. Good. So with this, we get to understand that we have risk attitudes. We have the risk attitude, we call the risk averse. We have the risk neutral. We have the risk seeking. So the relationship between risk and return is, the higher the risk, the higher the returns. The higher you keep on bearing risk, the higher you keep on getting the returns. So the relationship between risk and return is, the higher the risk, the higher the expected return. We hope you are getting it. So, for example, you don't know there are some schemes around that most of us have been joining, whereby as you keep on taking much risk, you keep on getting a return. And if they are taking your money away, they take it away. So, the higher that you are bearing the risk, the higher that you are also what? Getting returns. So that's the relationship between what? Risk and return. So as I said, you have the risk averse. So when you talk of risk averse, it talks of what? You are just the how do I explain it? Like, it prefers to avoid risks and opts for safer or predictable outcomes, even if it means lower return. So with the risk averse, it's like choosing a fixed deposit account with a guaranteed interest instead of investing in stocks with potential high returns but greater risk. So with risk averse, he's not trying to use all that the person wants is what? The potential return or the potential outcomes. So the person is not interested in very much risk. So instead of the person going to invest in stocks that will come up with a high returns but a potential risk, he will rather make it the fixed deposit. Even if it's a lower returns, he wants it. That's the risk averse people. We have the risk neutral. This risk neutral, for example, a person choosing between two investments based solely on expected returns, regardless of the variability in outcomes. So with this person, he's just choosing between two investments, but he's basing solely on the expected returns, irrespective of what? The variability in outcomes. That's the risk neutral. But the risk seeking, these people, they tolerate risk to the highest extreme. There are some people, they can bear risk, they can tolerate risk to the highest extent that if you don't even take care, you might think that they have their minds. Yes, it's part. All these are risk attitudes. Copy again. So if you don't want to bear risk in an investment or in business finance, if you don't want to bear it, we call them risk-free investment. They are the risks that don't come with what? Greater what? Or greater, or it has no potential risk involved. So some of the risk-free investment are what? The treasury bill, which is issued from or by the government. So in case the government wants money, or in case you go out to what? Invest in treasury bill, what are you doing? You are borrowing money to the government. And with this risk-free investment, it comes with what? A level of what? Percentage. These are called what? The risk-free what? Investment. These are investment that comes with no potential risk. And most at times, these risk-free investment are mostly issued by the government. So for example, risk-free, some of the risk-free investment are the treasury bill that are for short term, and for bonds are for long term. So all these risk-free investments will help you. If you don't want to bear risk, if you don't want your heart to cry out when there's a potential risk, it is better for you to what? Invest in risk-free what? Investments. Please hope you are getting it. Good. So with this, I want to explain this whereby you have, for example, we have the risky investment and the risk-free investment. So with the risky investment, it comes with a potential risk, but also a potential outcomes as well, or potential returns. So for example, a risk-free investment is having a percentage. So let's say if you invest in treasury bill, your returns is 20%. But if you invest in risky investment or in risky investment, if you invest in risky investment, you are getting for a percentage like 30%. So a risky investment is having 30% and a risk-free investment is having 20%. So the difference between the 20% and the 30% is 10%. So that 10% is called what? The risk premium. That is, since you are bearing higher risk, you are getting what? Higher returns. So the comparability between the risky investment 8% and the risk-free investment 8% gives you the risk premium. It gives you what? The risk what? Premium. So kindly take note of that. And this risk premium comes as you are bearing higher risks, you are bearing what? Higher returns as well. Please, I hope you are getting it. Good. We move on to the time value of money. So with the time value of money, the time value of money always say that the value of money what? Or the value of money changes over time. So that this time value of money is a key concept in finance and is relevant for companies and investors. So we are having two types of investments. We are two types of investors. We are having the institutional investor, and you're having the retail investors. So with the institutional investor, they are the corporate bodies. When I mean of the corporate bodies, they are companies or big companies that come together to invest. Please hope you are getting it. And the retail investors are the individuals with the what? Individual. So in a wider context, it is relevant to anyone expecting to pay or receive money over a period of time. So simply stated that the time value of money refers to the fact that the value of money changes over time. The time value of money what? Changes what? Over time. And there are some factors that account for it. So for example, as it's been given you, imagine that your friend offers you either 100 cedis today or 100 cedis in 1 year time. Faced with this choice, are you going to prefer to take the 100 cedis now, or you are going to prefer to what? Take the 100 cedis in a year time? So there are three factors that will work here, because if you take the money now, whatever that you want to use the money to buy, you can buy with it. If you take the money in a year time, say the time value of money changes over time, it means in case you get a year time, the value of money or the value of that 100 cedis will not be able to buy the things you could have bought if, or sorry, the things you could have be able to get if you're able to buy it within what? The time that it was offered you at a particular time. Please hope you are getting it. Good. So all these, we have some factor that is affecting it. The factors one. So imagine that your friend, as I said, that gives you 100 cedis today or 100 cedis in a year time. Faced with this one, will you prefer to take the 100 cedis, and why? So if you are going to take the 100 cedis now, there are some three factors. First of all, we are moving to time. So with time, you get to know that if you have the money now, you can spend it now. Alternatively, you can invest it so that in 1 year's time, you will have 100 plus any investment income you would have earned. So there are some factors that affect the time value of money as it changes. Time also counts. Time is not static. Time keeps on going and going and going. Hope you are getting it. Good. So one of the factors I said is time. And one also of the factors is inflation. So if you prefer to take the money now, you can buy the things you would want to buy now. But if you wait for a year time and you get the 100 cedi, the things you would want the money to, you would want to use the money for, you can't use it because of what? Inflation. So these factors can affect your decision making, whether to take the 100 cedis now or later. We have the risk. So the risk can be, it can be that in a year time I won't get my money, or in a year time I'll come back and you give me the a long explanation, a long because of this and that. That's the risk. So because of this risk, I will prefer to take the 100 cedis now. So these three factors, that is the inflation, risk, and time. These important factors affect your decision making as at the time as the value of money what changes over time. Please hope you are getting it. Good. So with this, we move on to starting a business. We know that a whole lot of us are starting businesses around, have mindsets. People are starting businesses and people are knowing, like, people are really doing business. So if you want to start the business, there are three questions that you should ask yourself. There are some questions that you should ponder on it. And one of the most important questions that you should ever ponder on it is first, what long-term investment should you take on what is the line of business that the line of business should you be involved, and the sort of buildings, machinery, or equipment will you need? Because you won't just first of all start a business without having the understanding of what you would want to do with it, or the particular place or where you want to move your business to. I hope you're getting it. Good. So with this, you get to know your line of business. That is what you should be interested in. The materials needed, the equipment needed, the things you should need. You should ask yourself, you should answer this question. What is the line of business? What do you want to enter into? Hope you're getting it. Good. And the second question is, where will you get the long-term financing to pay for your investment? Will you retain the profit which you make, or will you bring in other owners, or will you borrow money, or you borrow money from elsewhere? So, what are the long-term investment? What are the things that will keep the business going? What are the things that will help you get your investment as you invested into the business? Are you going to retain the profit? The retainment of profit means, are you going to keep the profit and use the profit to what? Keep the business running, or are you going to share, or are you going to share out what? Buy out or sell out shares for people to have ownership of the business in order for you to have money, or are you going to borrow money? Hope you're getting it. So with all these, you having the concept that if I'm starting a business, what should I be into? What is my line of business? First. Second, what are the things that I can do to keep my business operations running? Hope you are getting it. Good. So with this, we move on to understanding the third part, which is we're working capital management. That is, how will you manage your everyday financing activities, as collecting from suppliers and paying suppliers? How are you going to manage them? Calling what? The working capital management. The working capital what? Management. So these are not the only question, but any means they are the most important thing that you should take note of it. So business finance is, broadly speaking, study ways to answer these questions. So with business finance, we are trying to, if you want to start a business, what line of business should you be into? What's your long-term financing, or what are your working capital management? Business finance is trying to help us to understand how we are going to answer these questions. Hope you're getting it. Good. So with the answer of these questions, we move on to understanding the financial manager. So a striking feature of large companies is that owners, which is the shareholders, are usually not directly involved in making business decisions, particularly on a day-to-day basis. Instead, the company employs managers to represent the owner's interests and decisions on their behalf. So this is a situation whereby the agency theory or the agency problem comes in. Because with the financial manager, you see, since large company is owned by a whole lot of shareholders, they are not really involved in making decisions. So they have to appoint people, the management, they have to appoint people to be on their behalf in order that they will represent their interest and make decisions on their behalf. So the people that they are going to call out them stand in between them as mediators or intermediates for them to make decisions. We call them agents. We call these people agents. So they are the key tasks of the finance function. That's first the financial planning. So financial plan, this involves what? Developing financial projection and plans, such as you are knowing your cash flow statement and your profit statement. So the key task of finance function, the function of finance is to make sure that we are able to draw out a financial plan, or we are involved in financial planning, helping us to develop projections or financial projections and plans, which will help us to know the direction where the business is going to get into. Hope you're getting it. So we are having the second part, that's the investment project appraiser. This involves what? Evaluating projects or investment and assessing their relative merit and risk of competing what? Proposals. So with the investment project appraiser, finance function help us to understand the potential risk and return involved in each investment. So in case you are going to invest in this, you want to invest in any stock, finance function or business finance function will help you or will guide you to understand the potential risk what involved in making that investment. Hope you are getting it. Good. So the second part is financing decisions. So this requires the identification of financial requirements and the evaluation of possible sources of finance. So we are trying to identify the things that we might need in a business. We try to evaluate possible sources of finance, where we are going to get our income, where we are going to get some sources of finance, being it internally, externally, or from other what operations. So we are having what? Capital market operation. This involves an appreciation of how finance can be raised through the market, how securities are priced, how the market are likely to react to proposed investment and financing plan. So I hope most of us know the cryptocurrency. We have the other currencies, those dealing in what? Crypto trading or forex trading. We get to know that all these are capital market operation, because it helps us all it helps to our business finance or finance help us to appreciate how these markets are going to be raised, how securities are priced, how markets are likely to react to what proposed investment and financing plan. Hope you are getting it. Good. And we are having the financial control. This refers to the ways which plans are achieved. The ways which financial plans are achieved. So once plans are implemented, it will be necessary for management to ensure that things go according to plan. So finance function help us to control our financial activity, meaning whatever that has been planned or projected, managers have to ensure that they go according to that. Things work out according to those plans. Hope you are good with it. Good. So with this, we come up with what? The financial management decisions. The finance manager, what are the decisions that they make? We call them what? The capital budgeting. It's a process of planning and managing a firm's long-term investment. It concerns the first question of a firm long-term investment. So if a firm wants to invest in long-term or with a long-term base, first of all, there has to be a capital budgeting. That's the process of planning and managing the firm, its long-term investment. So any investment which being long-term, we are trying to find out how you are going to what? manage its investments. So capital budgeting is the process of planning and managing a firm's long-term what investment. We have the capital structure. The capital structure, it refers to the specific mixture of long-term debts and equity the firm uses to finance its operations. So it involves the ways in which the firm obtains and manages the long-term investment. So the capital structure refers to the mixture of debt and equity that the firm uses to finance its operation. So in case the firm uses loans, it uses other terms, other equity, his own money, his own capital to finance the operations of the business or to finance its operation when it's being on the long term what basics. Please hope you are getting it. Good. So with this, we are going to understand the working capital money. That's the third question. It concerns the working capital what management. This refers to a firm's short-term asset and its short-term liabilities. The short-term assets and short-term liability, the cash, how we are going to get cash, or some of these questions can be answered. How much cash inventory should we keep on hand? How much should we keep cash in hand? How much should we keep cash at the bank? So should we sell on credit? If so, what terms will we offer? To whom we are we going to extend to? How are we going to obtain, or how will we obtain any needed short-term financing? Will we purchase on credit, or will we borrow short-term and pay on cash? So with this, we are trying to understand the working capital money. Every day, the short-term base, the short-term asset, the short-term liabilities to finance what? The operations of the business. Hope you are good with it. Great. So with this, you get to understand the objective of a business. The objectives of a business. The objectives of a business. So the objective of a business is undermining, or is having a primary objective that a business is a shareholder wealth maximization. The primary object of a business is to maximize the wealth of shareholders of shareholders in the company or in everywhere. So that is to maximize the wealth of its shareholders. That means the owners. So those employed by the owners are expected to have this primary objective that we have to maximize the wealth, not the profits. So we have profit maximization and we have wealth maximization. Hope you agree with it. So in a market economy, the shareholders will provide funds to business in the expectation that they will receive the maximum possible increase in wealth for the level of risk which must be faced. That is how we go about it. Trying to understand, trying to know. So for the purpose or the primary object of, or the primary objective of businesses is to maximize the wealth of shareholders, not increase of profit maximization. Profit maximization is for short term, but maximizing the wealth of shareholders is for long term basis. Hope you agree with it. Great. So we are going to understand when evaluating competing opportunities, you get to understand. So the term wealth in this context refers to the market value of ordinary shares. So every time that their business operations, owners expect that their market value of ordinary shares increases. So when these ones increases, it maximizes their wealth. So when you're talking the wealth of the wealth maximization of shareholders, what we mean that there should be the market value of ordinary shares should increase. Please hope you are getting it. Good. So this will bring us to the end of our lesson for today, and we are going to continue and delve in much into business finance, talking of maximizing shareholder wealth or profit maximization. How we are going to go about these concepts, how we are going to go about these explanations will be coming soon. So I would like to end here. This will bring us to the end of our lesson for today. And this is Grade 8 Tutor. Like, subscribe as well, and make sure that you share the videos to your friends to have a fair knowledge of business finance and how we go about it. I go again by the name Ajima Derek. Welcome, and I wish you all the best. See you in the next video.